And so I'm going to try to translate that a little bit. Tell me if I'm getting it right or wrong. You're saying, look, I don't live and worry about this because I've worked so hard to put together this framework that you're walking us all through here that will tell me when it's time to ride the wave, and it'll start giving me signals to get out when and if we get to the point where positioning for a pop may become more timely.
100%. And this is exactly why we built our process to mimic the process of the funds that are charging 3 and 30 across global Wall Street. Obviously, we don't have the same caliber of models or the same caliber of intellect or the same breadth of analysts and portfolio managers on our team. But what we do have is, someone who's smart enough to try to mimic it.
And I would say you've got the same caliber of intellect or better. That's just my opinion.
I've been in all those buildings and rooms, man. I disagree, but I appreciate the compliment. But the key takeaway I would say is what we know from our studies in collaborating with those investors and just our general studies in terms of learning about financial markets. We know that volatility clusters, and obviously volatility is a derivative of price, so that obviously must mean gaps up and down, and price must cluster as well. And so what we built our discretionary risk management overlay and the tools that power it, which are also the exact same tools that power KISS, which we can conclude with later. The same tools, they're all the same tools based on the same concepts, which is you want to be in the markets when it's time to be in the markets, and then you don't want to be in the markets when it's not time to be in the markets. Right. And that's exactly what Dr. Mo helps investors do. When you go back and you look at the cumulative performance of the S&P 500 since January of 1998, if you're only long the market when Dr. Mo tells you to be long the market, which is a trend-based, trend-following system, then you would get 131% of the return that you would otherwise get from being in the market. So that's 1.31 times whatever the return of the S&P 500 was when you're in the market. And so obviously that means, when you're not in the market, when Dr. Mo tells you not to be in the market, the S&P is going down. And so This is how you chop off left tail risk from a distribution. You basically want to have some sort of reliable quantitative risk management signal that says, don't be long here. And just by not being long there and only being long in this part of the distribution, you're going to increase your absolute and risk adjusted returns. And that's what we've been doing for years for our clients. And aside, most for investors who want a little bit more context around this market regime nowcasting process, that is the basis, it powers our entire quantitative risk management signal. Historically speaking, when you're in a bull market, so if you go back and look at a trailing 3, 5, 10, 20-year basis, there's really only 2 roll phase transitions per year on average. So that means you're in a bull market, you have 1 roll phase transition down to a material enough correction that warrants doing something differently in your portfolio to essentially mitigate the volatility drag associated with that potential crash, because you don't know if it's going to be a crash or not in real life. And then 2, you recover back to the prior bull market. Or if you're in a bear market, it's basically that in reverse. So you're in a bear market, you have a big enough, a rally, big and long and sustained enough rally in the context of the bear market to warrant, repositioning your portfolio to keep your seat on the buy side or to avoid, FOMO as retail investor, and then ultimately you return back to the legacy bear market. So, and you look at 2025, it's been a perfect year. We were in a bull market heading into 2025. I was on your show saying I'm about to be as bearish as I possibly can be before the KISS and signals.
Again, this is why I give you so many props, right? I mean, you were so bullish starting at a time where almost nobody was. You maintained that for 2 years. I don't think anybody thought at the start of 2023 we're going to back-to-back 20% years. You started 2025, I think still bullish, but then very, a couple months in said, hey, whoa, wait a minute. Now it's the time to be bearish. I even think you said ragingly bearish, if I remember correctly. Right. And then pick up the baton here.
Yeah, no. So I said, hey, look, I think at some point in the first half of this year, we're going to see a roll phase transition to a crash. I think might have been back in late January when we were having this conversation with you. I said we're going to roll phase transition into a crash, and then we're probably going to roll phase transition back into a ripping bull market. We said, I think I might have been on your show when I said this, 1998 is the best analog to think about the distribution of probable economic market and policy market outcomes for 2028 or for 2025. You recall, we basically had the same dynamic in 1998. Yep. We're in a raging bull market. We crashed, we recovered quickly, and we ran into a bubble. I think it's a very legitimate risk still. And having said that, in the first quarter of this year.
Okay. And again, it's sort of generalizing risks. I'm taking a strong message from you that the you perceive the higher risk right now is the risk of missing a continued dramatic appreciation in the market right now versus the risk of getting caught by some really big market drawdown in the near term.
Yeah, 100%. I mean, this is until we roll phase transition out of this risk on market regime. And I don't know why we would think differently.
How does your model pick up on that type of risk?
Yeah, that's a great way to put it. So there's two ways in which we would do that. So the first way, I'm sending a request to share a screen.
Yeah,
Um,
absolutely.
so the first way I would always start with anything that's developing, whether it be bullish or bearish, is what are the quantitative risk management signals saying? Because that's the leading edge of our process.
Yeah.
Leading edge of our process is what are institutional investors doing from a volatility and price perspective to asset markets that it sort of indicates their underlying flows. And so when we go and we look at our global macro risk matrix market regime nowcasting process, that's the core model that powers KISS and Dr. Mo. You can sort of see the nature of the disturbance in the kitchen there. When we were talking on Tuesday, we were in a very high strength of signal Goldilocks market regime. I want to say the strength of signal back on Tuesday was 86%. It has since declined to 66% because we're starting to lose confirming markets. I want to say Goldilocks was at 29, now it's at 27. Reflation was at 20 or so, now it's at 17. And so ultimately, what it means is the probability, the shape of the distribution is evolving in a manner that is bearish. The probability associated with the two risk on market regimes is declining, and the probability associated with the two risk off market regimes is declining or is increasing. And so that doesn't necessarily mean that we're heading for a robo phase transition. It probably means at the bare minimum we're headed for what we talked about earlier, a 5 to 8% correction. However, this is the kind of stuff that should have your antenna up from a fundamental standpoint, because it does suggest that asset markets, as a function of those institutional flows that we're tracking in the global macro risk matrix, are moving from what would be a positively skewed return distribution to something that at the bare minimum looks Gaussian skewed. And the delta shift is negative. And we have to respect that. And that's what KISS and Dr. Mo picked up on this week in terms of the signals that they sent to our clients.
Okay, and this is great, folks. So you're actually watching the value of the model in real time here, right? Which is you're seeing. We a few minutes ago we saw a version of this slide that had pretty much Goldilocks fully in the driver's seat, and all of a sudden you're seeing these other regimes all of a sudden start to increase their competition for the crown here. And of course, that's what then informs the model. Like what I said is, hey, no matter how Darius feels when he wakes up in the morning emotionally, he doesn't trade on that. He trades on what the model tells him to trade on. Well, this is the model actually starting to sort of change its signal in real time here.
100%. It's all about the shape of the distribution of probable economic policy and market outcomes, and that shape of the distribution is evolving.